All right, good evening, everybody. Welcome to this live class Sunday night. I'm always happy to be in class to share, because you cannot overshare, you cannot overteach. Okay. And one thing about Forex is that from my experience, there are certain things that you have to say again and again and again and again before you get it. Before you get it. Sometimes it looks like revelation. Like a revelation that you have to um, say again and again. So when you say it, when we teach certain things, you you may not, because it's not something that you can cram. It's something that you have to understand, and you may not get to understanding the first time. So you keep saying it again, 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 again. I was speaking with someone just a moment ago. Okay, it's like someone like a daddy. So we were talking about impulsive movement, retracement, saying that that there are certain, even though I've been teaching that thing, I've been sharing it for a long time. There's something that I got to understand sometime last day about impulsive movement and retracement. Impulsive movement and retracement that I did not know, prior to that time. Okay, so tonight I want us to go deeper. I want us to continue from where we stopped. And some of you that are struggling with opening your account, make sure you get your account ready. You will not be able to do the assignment if you don't have your account. If you don't have your account ready, if you don't have your account ready. So make sure you open your account. So make sure you do proper opening of your account if you are still struggling with it. Okay. You can always go to the website apicts.net or use the link that is on the WhatsApp group to open your account. Okay, so let's really go deeper. Let's get to the slide. All right, let's go deeper. Are you seeing my screen? If you can see my screen, just type 2 in the comment section. Type 2 in the comment section if you can see my screen. If you can see, let's go deeper on the screen. Just type 2 in the comment section. Type 2. Just type 2 in the comment section. You can see, let's. Now, when it comes to trading Forex, there are three forms of market analysis, three major forms of market analysis. We have the technical, we have the fundamental, we have the sentimental analysis. Technical analysis is what we have been doing so far and what we're still continuing to do in the next couple of classes. We're talking about technical analysis when you use your price, your candlesticks, your historical price movement to forecast into the future. The future price when you use the past records, the past price movement to forecast the future. The fundamental analysis is when we use the economic data to if the economy of a particular country is bringing us certain policies or has a record of that can promote or that point to the development of that country, is that whether you buy into that currency and then you are going to make profit. Okay, then we have the sentiment analysis. This is somebody was saying something yesterday. He was saying that I was watching a video. He said, "Do you know that every October gold usually get very, very bullish every October every year?" That's sentimental. They're probably not really a fundamental, a news data about it, but because one or two things just lead to it. It's just a little biasness. For example, when Trump come into the office and then you believe that, oh, USD we appreciate, so and so we appreciate, blah blah like that, and then just no economic data yet, but just a forecast, just a biasness. So just sentimental. Now, I want us to go deeper this today. So technical analysis now. So let's get to the slide. In this session, you will be introduced with technical analysis. to help develop the foundation needed to understand simple technical concepts. Simple technical concepts. So you will be introduced when it comes to technical analysis. Technical analysis is when you is a concept, okay? Is a concept in determining your entry and exit in the market. So let's go deeper into definition. Definition: technical analysis is the study of past price activities, forecast the future price direction. Technical analysis is the study of past price activities in order to forecast the future price direction. I'll take it one more time. Technical analysis is the study of the past price activities in order to forecast the future price direction. It is the study of historical price movement. And remember that history has a way of repeating itself. It is something that you need to put in your mind. You must have heard me saying that before. History repeats itself. History repeats itself. It is the study of historical price movement, and remember that history has a way of itself. One thought usually comes to my mind every time I read this slide. I used to tell people that in 1993, okay, it was Yoruba man that won 1993, 2023. Declared the winner of the election in the country, Nigeria. History repeats itself. So let's go further. Okay, now, so the primary aim is to focus on the statistical analysis of the price movements. That's technical analysis. The primary aim is to focus on the statistical analysis of price in order to understand price action evolving into trends in the market. So when we talk about technical analysis, we're talking about when you identify the trend of the market. Sometimes people use indicators to determine the moving averages to determine. I think I'm going to be teaching you that in the next couple of maybe the next two classes, talking about indicators that you can use to make money in the market, and then you can use candlesticks and price action. We'll be talking about candlesticks for some time now. Then you're talking about indicator moving averages. Moving averages. Two I'll teach you one indicator, and then I'll teach you moving average. Moving average is powerful. Then you talk about support and resistance. I remember yesterday, the class I recorded for you, I was teaching you support, resistance, support, resistance. So these are the elements that make technical analysis. Talking about trends, trend continuation, trend reversal. We're talking about the chart pattern, talking about double top, double bottom, triple bottom, head and soldiers, inverse head and soldier, talking about chart patterns, talking about support and stop moving average. All of this we're going to cover in the course of our training. Now, what do you see in this place now? I can tell you, can you predict? This is where the price is. The question is that how do you know that price is going to fall from here? The big question is, how do we know at this point that price was here up to, look at the next thing that happened on this slide. Price that was here before, price that was there before fell. How will you know that this is going to fall? That is technical analysis. Technical analysis. And when you understand technical analysis and you develop an edge, at the end of this training, all that I'm trying to do is to give you an edge in the market. Because the moment you get an edge in the market, with that edge, you can make profit consistently forever and ever. See, listen, I did not say that there is an edge in the market that you never lose money at all. There is nothing like that anywhere. There is no forex trader who does not have losses. You can only have more profit than losses. Some people have times 10 of whatever, times 10 in profit or whatever loss they have made. People have, massive profit in the market, massive crazy profit in the market. But no matter how much profit you make, there is nothing like, oh, I've never lost. I don't lose any trade. My strategy is 100%. It's an only great strategy. There is nothing that except somebody that wants to deceive you. Even if you use a robot, even if you use a boat, there is no boat that makes you to make profit without ever making a loss. That is how those were. That is what those that trade see best did not know. Sometime last year, they give a strategy. You just press something loss at all. CBS at one particular time, another set of people came to the market, ICPC came to the market and they said, oh, they never made a loss. That's how you will know that they are scammers. Every platform that you engage in and that they are promising you a percentage of your income every single month, and then they press something to make profit, and there was never loss at all for 90 days. You know that CBS actually ran for about 4 months and they lost. Come on here, come on here. There's nothing like that. They are all is a scam. But then you can have an edge in the market. You can have a strategy that can give you profit, far much more than you lose in the market. So at the end of this training, all I'm trying to do is to deliver into your end a strategy that can give you far much profit than the loss. Okay, so now let's go for it. Now we're getting deeper now. We're getting very, very deeper now. And it's getting very exciting now. It's getting very exciting now. Now, going back to 19th century, the father of technical analysis, Charles Doe, observed that it is direct and troughs that defines the trend of the market. Direction of peaks and trough that define the direction of the markets, that define the trend. I already explained that one to you, so there's nothing complex in that statement. I already said it to you yesterday. When the market is making higher high and higher low, the direction of the highs and low is what reveals the future higher highs and higher lows, higher highs and higher low. It is said to be in an uptrend. So the direction of the peaks and trough, impulsive movement, retracement, impulsive movement, retracement, and it's the direction of the market. So when it's making higher high and higher low, it is said to be in an uptrend. When it's making lower high and lower low, it is said to be in a downtrend. Very simple. As simple as that is the foundation of technical analysis. The foundation of technical analysis. So you say the direction of peaks and troughs that defines the trend of the market. The direction of peaks and trough is what determines the trend of the market. Please take note, for God's sake now, for God's sake, for God's sake, for God's sake. There's a particular guy who is on who I don't know how I find myself in his Telegram group. He always want to give signal at the assuming the beginning of a pullback. Hey guy, calm down now. And this is good. It's not your father's business. And it's always you will lose money, lose money. Of course, you will make a little back too, but then you say the gold is about to come down, it's about to come down. Then you say, come on, let me have a clear signal, a clear direction of peaks and troughs before I jump on the trend. The direction of high and low is what reveals the future movement of the price. And this is what we're talking about. Higher high and higher low trend. So when I begin to see something like this, it's high and low and higher high and higher low, it is said to be in an uptrend. So this is what's going to reveal in the future. I should be expecting price to continue to buy until I see a clear reversal. Until I see a clear reversal. And I hope you are hearing me. Now, the same thing happens for a downtrend. Okay, it is the direction of peaks and troughs that determine the future price movement in the future price direction. It is the direction of peaks and troughs that determine the trend of the markets. They tell you the trend of the market. So in this kind of market now, I've been thinking of selling. I've been thinking of selling. I've been thinking of selling. I'm going to join the sale. It's for the future teaching. Don't worry, we're going to get there. I just need to establish it. It has to be in your subconsciousness. It has to be in your subconsciousness. And so we have this arranging market also where we sell at resistance, we buy at support. We buy at the support, we sell at resistance. Let's go deeper. Let's go deeper. I like this. I like it. Now we're getting deeper now. Understanding. So we have the uptrend. Look at it now. Look at that diagram. We have the uptrend, or the downtrend. We have the ranging market. Uptrend, downtrend, ranging market. Now and retracements. Wow. Please pay attention. Understanding reversal and retracement. If you see people that lose money a lot in the market, this is where most time the problem is. The problem is usually assuming retracement is a reversal, or thinking thinking a reversal is a retracement. Assuming a reversal is a retracement is usually the problem. A reversal is defined as a price turning point to the opposite direction of the previous trend. The reversal is not all this that looks like complex and theoretical, they're very simple. Don't worry, I'm just trying to establish theoretical understanding first before we get to the practical. The reversal, a reversal is defined as a price turning point to the opposite direction of the previous trend. A retracement is defined as a price pullback in a trend. Like I told you, I've already explained different part of this yesterday in class, in the video I sent to you, and I hope you have watched it. A retracement is defined as a price pullback. So I said impulsive movement, retracement, or pullback, or correction. They're saying the same thing. Impulsive movement, retracement, pullback. Look at it now. It is an impulsive movement. It has a little retracement. It also means correction. It also means a pullback. So a retracement does not signify a change in the larger trend. A retracement does not signify a change in the larger trend. So don't think when the price is pulling back, don't think, oh, imagine here now. This is what we're talking about. Between here and here, between here, between here and here, don't think a sell has started. The market is still buying. This is just a pullback. This is just a pullback in the market. This is just a pullback in the market. It is not a sell, it's a pullback. This is a pullback in the market. So it's a retracement, it is not a reversal. It's a retracement, it's not a reversal. Don't try to sell here, especially as a beginner. Don't try to sell here. It's a retracement. It is not a sell, it's not a pullback. So you wait for the end retracement, and then you join the impulsive movement again. That's exactly what I'm trying to say here. Okay, now let's go deeper. Yeah, this is where you need to pick up your pen and write. My. I love this. 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 This is what I said I was going to teach you tonight. That will make you more profitable than you can imagine. You can imagine in the market. Oh boy. Oh boy. Oh boy. Oh boy. Are you ready to hear this now? This is the essence of this night class. Are you ready to hear this now? If you are ready to hear what I'm about to teach you now, just type 3. Type 3 in the comment. I love this. I love this. Type 3 in the comment section. If you're ready to hear what just type 3 in the comment section. Oh boy. All right. Okay, beautiful. Let's go. Let's go there. Now, thus, okay, thus, when the price when the market experiences two peaks and two troughs successfully higher than each other, then the market is set. When the market experiences two peaks, if you will say peak is P, and then trough is T. So when it experiences P1, P2, and two troughs, T1, T2, successfully higher than each other, then the market is said to be in an uptrend. Look at it now. This is a peak. This is a trough. This is a peak. This is a trough. P1, P2. Sorry, P1, T1, P2, T2. Anything above that now, the market, that means an uptrend is already established. An uptrend is already established from what we are seeing here. When the market experiences two peaks, see, if all you know in technical analysis is what I just said on this page, I've made it. And if you can abide by this for the rest of the experiences, two peaks and two troughs, it's said to be in an uptrend. So when I see P1, T1, P2, T2, then uptrend has started. Uptrend has started. I'm going to draw on the chart. I'm going to show you. So let's continue. And of course, the opposite is true. For a downtrend, that is when the market shows two peaks and two troughs, so it's lower than each other, then the market is said to be in an uptrend, in a downtrend. Of course, the opposite is true as well for a downtrend. That is when the market shows two peaks, P1, P2, and two troughs, T1, T2, successively lower than each other, then the market is said to be in a downtrend. Okay? Okay? See now, P1, P2, sorry, P1, T1, P2, T2. Here, henceforth is a bullish market. Then you see P1, T1, P2, T2. Henceforth, the market, that trend is already established. Is already established. So the work of Charles H. Doe and his partner Edward Jones, Doe Jones and Company since 1882, back in the end of the 19th century, also known as the last tenet of Doe Jones theory, states that trend remains in its effect until a clear reversal occurs. Trend remains in its effect until a clear reversal occurs. Trend remains in its effect until a clear reversal occurs. That means don't assume that there's a reversal in the trend until it is clear on your chart. I used to tell people, don't trade what you think, trade what you see. Don't trade what you think, trade what you see. Trend exhaustion leads to trend reversal. Trend exhaustion leads to trend reversal. Trend exhaustion leads to trend reversal. Okay? Okay? Then I'm not teaching you how to trade trend from the next class. From the next class, we're going to be talking about how to use AMA, how to use ADX, how to use trend line and trend line breakout, how to use Fibonacci. All of this is going to start covering one how to trade trendy markets. Okay? So let's get to the chart. Are we still together? Are we still together? All right. All right. So let me share the chart with you here. All right, are you there now? All right, so let's go there. Now, okay, so this is like what I wanted to share, but let me delete it and do another one. Now, here is what it's talking about. It's saying if you have something like this, market is making higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. It's saying this, okay? This is a pullback, or this is what it's talking about retracement. Retracement. So it's what it's saying invariably is that don't think market has started selling here. You have to establish a support, then a resistance, then a support, then a resistance. Now saying that, look at the theory we are looking at now. This theory now say, well, as long as it's making higher high and higher low, it is trend market. As long as this is happening now, it's saying don't just worry yourself. It's an uptrend market. So all you'll be looking for, all you have to join the buy again and again and again and again. Okay, just looking for where to join the buy. It is an uptrend market. It's an uptrend. So market is technically buying uptrend market. Uptrend. Uptrend. Now, Now, this price is now saying something that now for this market to remain, when will you know that the market has changed from the bullish market, which is an uptrend market? Okay, how do you know that the market has changed from bullish market to a bearish market? So that you know trend is your friend, trend is your friend, and you must follow in the direction of the trend. And the beauty of a professional trader is to join the trend from the very beginning. That is the major thing a professional trader is looking for. How to join the trend from the very beginning. Now, here he's saying that look, you need to understand that when this pullback here now, let me delete this. This pullback must not get within, either it get to the exact, you discover that this support is not lower than this support is not lower than this support. It was making higher high and higher low. This is higher low, higher low, higher low. It must be higher than the other. Now this law now says that when you begin to see something like this, begin to see something like this, then it started. Now this this philosophy is now saying that from here you begin to look for opportunity to sell. So here becomes your P1, your peak. Your peak one, okay. Then your trough one, TROUGH, trough one. Then your peak two. Then your trough two, your trough two. You know, your so your trough one. Okay, this is exactly what we're trying to say now. Now, from here now, for example, if this market moves from here now, if this market move this way, I'm going to be entering a sell. I'm going to be entering a sell at this spot now. I'm going to be entering a sell here. You enter a sell here, then put my stop loss. And this is when you get to know that okay, the bullish trend has stopped, the bearish trend has started. So that's the law, that's the Dow Jones law, that when the market makes two successful peaks and troughs, successfully higher than each other, it is said to be in an uptrend. When they make it lower than each other, it's said to be in a downtrend. Lower highs and lower low. Okay, and make another pullback again to this side. My goodness, and close it like this. And close it like this. That same theory says that, oh, this is not what I'm trying to do. This is what I'm trying to do. You see this coming like this, lower highs, lower lows, lower highs, lower low. All of this time you are still selling, you are still selling. Lower high, lower low. All of a sudden, you saw that this one now closed above the previous lower high. Then something will tell you, first of all, and go up again. The principle here is that resistance, it must not break the resistance. Now here now it has broken the resistance. It has broken it. The moment it breaks, then you begin to then you bring out your labeling tools. You count your, this is now my P1. Then you count your my P1, then my T1. Then you put my P2, then you put my T2. T2. Now, the moment you do that, from here onward, you can begin to look for a buy from here onward. From here onward, you can begin to look for a buy from here onward. From that place onward, you can begin to look for a buy. You can begin to look for a buy from here. So let's see a typical, okay, let's say a typical example here. Let me show you some example. All right, so let's see something like this. Look at this market now. This market is let's see this market from here. Market is forming like this. Up, forming lower low. Don't forget, it must not break this. As this one is not breaking, it must not break. It must be getting lower than each of a sudden. Market has broken this one now. It's stopping. So now all of a sudden you see that, oh, price is changing direction. Oh, price is direction. So you bring out your pen and begin to label. This one that was broken, this last one that was broken is your P1. Your P1. Then its low is your T1. Now the next one that broke it, okay? The next one that broke it is your P2. My P2. Where will I put my T2 like this? Let me put my T2 here. My T2. Okay. So I have my, now what the price is now telling us is that, what that theory is telling us is that from here onward, we can begin to look for buying, market is still buying, till okay. So that market, you can buy it till this place. You can buy it to this place. You can imagine if you are buying this market, from here, imagine you are buying this market from here, from this P2 like this. Imagine how many pip that is. You are buying it from here. So here now, you will see that P1, P2 again. This is getting lower. Okay. Can I count my P1? This is my P1. My P1. Then my T1. Then my P2. Then my T here. For my P2 now, I can begin to look for a sell. Are you still with me? From my P2 here now, I can begin to look for a sell from here. That is trend reversal. I can begin to look for a sell direction again. I can count my P1, P2, T1, T2. Now look, right, market didn't go so far in that direction. So here again, I count my, look at it again, price has changed direction again. My P1, my T1 ambiguous. Okay. So here now, from here now, I can look for a buy. My trend line, trying to use my Fibonacci, trying to use my trend line breakout, trying to use the whatever I can get an entry. P1 and P2 is telling me that there's a trend reversal now. So if you have been selling before, begin to buy. And if it's a sell market, if the bullish market before, if I've been buying before, begin to look for where to enter a sell. That's exactly what we're talking about. Okay, so that would mean by trend reversal, that as opposed to retracement or a pullback. So the difference between trend reversal and your chart, you use gold, UGBP USD, and USD JPY. You will show me your P1, P2, use 1 hour time frame, and your P1, P2 direction. That is the assignment for this night. Now you have two assignments now. Market, you have not shown me that one. I said pick currency pairs that I've shown you in the previous chart. Show me an uptrend market where you have your higher high and higher low, two examples per currency pair. Then you show me lower high and lower low. Then you show me a ranging market. I already gave you the example. Then you must do it. This is second assignment now. The second assignment, pick gold, GBP USD, USD JPY. Then you also pick volatility. Pick volatility 75, crash 1000, boom, 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 boom 1000. Show me your P1, P2, your T1, T2, how it signifies a change, in direction, a reversal in the trend. That's the example for this night. That's the assignment for this night. I will see you again. Thank you. If you have questions, please drop it on the WhatsApp group. Thank you. Good night.